What's up everyone? Ross here from Warrior Trading. In today's episode, I'm going to walk you through how to day trade stocks with bigger spreads. Today we have a perfect example, a stock that makes a huge move, but the whole time it had a big spread. It goes from $12 a share up to 15, to 18, to 20, 22, 25. Wow, it's 100% right there. Goes up to 30, 35, 40, 45, 50, 55, to a high of $57 a share. This is wild. That's a ton of volatility, a lot of opportunity, but the whole time it had big spreads. Right now, the spread is 60 cents as I look at it right now. Wow. So how do we trade that? How do we manage our downside risk while participating in the upside potential? We have to think about risk because we're traders here, not gamblers, right? So we've always got to think about risk first. So I'm going to walk you through the way I approach trading these stocks. I've traded stocks with big spreads over the years and I've had some phenomenal trades, but I've also gotten burned a handful of times. Well, probably more than a handful. So I can share with you some of my lessons that I learned the hard way on trading these stocks with bigger spreads. I hope you find this episode interesting. If you do, and you want to learn more about my day trading strategy, there'll be a link that you can check out right in the description where you can download my gap and go strategy as a PDF, my micro pullback strategy also as a PDF, and my technical analysis series also as a PDF. So you can download those, you can print them out, you can keep them right on your desk, and those will help you in your trading. So make sure you check those out. Link is right in the description. And let's go ahead and jump in by looking at this stock, OMH. Okay, so this thing makes a huge move today. Right now it's on the backside of the moves. We're coming into the close. Only got about 26 minutes to the closing bell. Kind of looks like a head and shoulders pattern. The squeeze up, shoulder here, head, and then the leg back down. So as you could see during the move up, it's a big move. There's no question about it, from $12 to a high of $57 even. But the whole time it was trading with bigger spreads. In fact, there was one point where routinely this was 50 cents to $1 a share, but I saw a spread of $3 a share at one point. And if we look closely at this candle, let's see, I could show you a candle that has a 9-point range. You want to see that? Okay, look at this thing. Look at this candle right there. See that little guy right there? Holy smokes. That's 9 points in 1 minute. All right, so we've got a lot of risk here on this stock. We have to figure out how to manage our risk. So for those of you guys that aren't familiar, let me give you a 2-minute lesson on the BidAsk Spread, and I've got my whiteboard up right here. So every stock trades with the BidAsk Spread. You've got the best buyers on the bid. The highest price buyer is right here. And then the lowest price seller is right here. And in this case, we've got a 50-cent spread. Now, I don't mind trading stocks that sometimes have a bigger spread, because if you think about it, what does the bigger spread tell us? It tells us the stock has the potential to move very quickly, right? Why would a stock have a bigger spread? Well, if you had a lot of buyers and sellers, then orders would fill in, thus creating a tighter spread and more liquidity, which means the stock's not going to move up very quickly, but it's also not going to drop very quickly. And that's appealing for investors. So a stock like Bank of America, these are going to be thickly traded stocks. That's a good thing. But we're traders. We like volatility. So a little bit of a more thinly traded stock, that's okay. And that usually comes hand in hand with a slightly bigger spread. But then you have something like OMH, and dare I say, too big of a spread, too much volatility. I don't know, beggars can't be choosers, but this is quite the spread. So what ends up happening here, sometimes traders say, Ross, I find it interesting. I get this feedback all the time. Ross, you don't talk in terms of percentages. You're always talking about how much you made. You're up $3,000, $5,000, $20,000, whatever it is. Well, what is that in percent? How much money did you put into the trade? How much of your account did you put into the position? And I don't talk about it like that because I don't think about it like that at all. I'm always thinking about these trades in cents per share. Why is that? It's just the way I think a lot of traders think, day traders like myself. So if I buy a stock, I'm thinking about quantity of, let's say, 5,000 shares, or let's say 10,000 shares to keep it simple. So if I make 15 cents a share, that's $1,500, right? That math is easy. $1,500 is the same 15 cents, whether I got it on a $3 stock, and that's a 5% return, or I got it on a $30 stock and it's only a 1% return, or whatever, less than 1% return. It doesn't really matter. 15 cents is 15 cents. That's the way I think about it. So here's the problem. Let me show you this. So if we have a stock that has a spread, bid-ask spread of 31.10 by 31.60, that's a 50-cent spread. So if I want to take 10,000 shares of that stock, let's forget about the fact that that's 300 grand in the position. I don't really think about that, generally speaking, because for me, I'm really thinking about my risk in these senses, in these terms. Number one, entry, the difference between my entry and my stop. That's my risk, all right? So if I'm getting in at 31.10 and my stop is 31 even, I'm risking 10 cents. Now, I'll tell you, the fact is, with a stock like this, and when you see a spread like this, that right now is 29.50 by 29.80, but you see it jumping around, you're not going to be able to get a 10-cent spread. A 10-cent stop. There's no way your stop's going to be as small as 10 cents. In fact, most likely, you should look at whatever the spread is and figure that's most likely going to be your stop. So if you have a 40-cent spread, you should probably have a 40-cent stop below the bid. All right. So in other words, on our whiteboard here, if we're in at 31.10, our stop is probably going to be, 30.60, 30.50, something like that. That's realistic. Okay. So now this is a problem because most momentum day traders, when we buy, we're buying at the ask. So we buy the breakout here. And if we're in at 31.60 with a buy order, our stop is now 30.50 stop. Uh-oh. So what's the problem here? Our stop is $1.10 away per share. On 10,000 shares, that's 11,000 bucks. And it doesn't matter if you're trading with 10,000 shares, you're trading with 100 shares, it's still $1.10, which means how much should you stand to make on this trade in order to justify the risk? All right. So you need to be able to have the potential for 2 to 1. That's kind of a rule of thumb, golden rule for most traders, which means here we need the potential of $2.20 per share of profit. Okay, we're setting the bar pretty high. And this is where we have a problem with these types of stocks. We're setting the bar high. It makes it harder to be successful. In fact, you take one loss of $1.10 a share, that would wipe out so many small winners. And a winner on this of 50 cents or 75 cents a share isn't enough to justify the risk that you took on the trade. Okay, so now if you need $2.20 per share in order to justify the risk, you're gonna have to be really selective about what setup you're willing to take. So now let's look back at the chart. Show me a really good setup on this chart. Son of a gun, I don't even see a single really good setup. And I'm being honest here. I don't see a single fantastic setup on this 1 minute chart. You could say it moved really nicely right here, but what setup was that? What setup was that entry? Why would you have bought here and not bought right here? Both times, look similar, but it went here. The trade through the high of day, that's way too risky. Look at the false breakouts you had here. False breakout there, false breakout there. Right here, pullback? Okay, maybe. So that might be one of your cleaner setups, that first pullback following a fresh breakout. But let's look at the low of that candle. The low of that candle down there was 36.35, and your first 1 minute candle to make a new high was at 40. So based on technical analysis, our proper stop is at the low of that candle. Now, that's using a stop not based on your spread in level 2. This stop here of 30.50, that's based purely on the level 2. And you don't really want to set your stop based on that. You want to set your stop based on actual support on the chart, which means you have a 4-point stop. A 4-point stop, now you need to get 8 points to get your 2 to 1 profit loss ratio. That doesn't even make sense. And then you get this false breakout, as you can see right up here, false break, this big whip up here, another kind of nasty move here, and then we were on the back side. So to be honest, I don't see a single clean setup on this particular stock today. Now there's other stocks that I've traded that have big spreads that did end up giving us some nice pullbacks, some nice clean entries, but this unfortunately just didn't happen to be one of them. So on this particular stock, you sort of had 2 options. One, you could have taken some breakout trades like that entry at $40 and just done like a quick scalp. You're in it and you try to get out quick. You're not going to have good profit loss ratio on it because if you take that trade and you lose, it's going to wipe out a lot of the small winners. But you could have done that. Now, I wouldn't probably encourage that because you would need to have like 80% accuracy to make money. Because like I said, if you have one loser, it's going to wipe out the winners. So for most beginner traders, there isn't a single setup that probably would have been safe to trade on this, on the 1 minute chart. Now, if you look at the 5 minute chart, you might say that this setup here around 29 maybe made more sense. But again, given the spreads, given the 3 topping tails in a row, I think the risk was really high to take that even as a 5 minute setup for any beginner trader. I don't think that you have good risk reward on this particular stock. So, but let's look at the whiteboard here for a second. Something that's kind of interesting. Let's just let's change the numbers here a little bit. Let's pretend for just a second that we're dealing with a stock that's $3.11 instead of $31.10, and it's $3.16. Okay, so now we've got a 5-cent spread instead of a 50-cent spread, right? You see what I did there? It's just divided by 10. All right. Now this is a different ball game. I'm totally okay with trading this. Now what's funny is for those of you guys who think in terms of percentages, these are the same ratios right here, right? This is to this as that is to that. They're the same. And yet this to me is completely different. I'm totally comfortable getting in this at 316, 311, 5-cent stop, right? So 5 cent there, add another 5 cents. So now you're down with a stop at like 306. So you got a 306 stop, just like that's like the tightest stop you could probably get. That feels reasonable. And this is a stock that we trade like this all the time. And we routinely will see a squeeze up to 325, 330, 340. But you know what? It's a lot easier for a stock to go up 30 cents a share right here like this than it is for it to go up $3 a share. They're the same percentage. Well, doesn't quite matter. 30 cents is easier than $3 a share. It's just the way it is. That's why I really like trading stocks that are between $2 and $20. So my kind of rule of thumb, and if we look at this stock today, and many of you guys who know the way I trade and you're familiar with my strategy, you know that I kind of have this rule of thumb where I focus on stocks that are up at least 10%, that have relative volume of at least 5, that have news, that have a price between 2 and 20, and that have a float of under 20 million shares. That's kind of my 5 criteria. Now, there are stocks that are going to be within that range that I like more than others. There's some other factors that can make a stock especially exciting. Blue sky setup, recent IPO, recent reverse SPAC, different things like that. I talk about that a little bit in some of those PDFs. So if you go to the description and you download those, the micro pullback, the gap and go, and the technical analysis series, you'll see some more content around what I really, really like. But the fact is, OMH today, well, so this is a problem. The float's 20 million shares. Okay, so that's all right. It was up more than 10%. Okay, but if you look at the chart, this one had a little bit of an unusual chart. Pre-market, it made a big move up to 30, if you see this, and then it sold off. Whoa. So now this is a different context. So the context of this specific chart shows us that when it was at 14, it was 50% off its pre-market high. So now when it came back to 28, 29, it was sort of a double top. Ah, man, that's a weird setup. This pullback. So now you're starting to get a little bit more context of why this one may have been a little harder than another stock that had similar spreads, but didn't have that same kind of weird pre-market chart. So one of the things that I'm going to focus on are stocks between 2 and 20, because again, it's easier to get 30 cents or 50 cents than when you're trading a stock that's 30 or 40 and your profit loss ratio needs to be $2 to $3 a share. They're just going to be more difficult, especially for those of us that like to do quick breakouts, get in, get out. Because one of the other things that I'm thinking about with risk, I'm thinking about the difference between my entry and my stop, right? So that's my risk, and it's in cents per share. Cents per share is easier to manage on the lower price side of things. But I do think about risk in terms of total exposure. So a $30 stock, 10,000 shares is 300 grand, right? That is a lot of money. Now, that's usually not a problem, but it's a lot of exposure. And if you have that exposure risk and then you have to hold that trade for a long period of time to get your 2, 3, 4, 5 points, that amplifies the risk on the trade. So to me, it feels so much easier in a way to be focusing on lower price stocks, getting 20 to 30 cents a share, doing that with 5 or 10,000 shares, getting $2,000 or $3,000, than trying to mess around with a $30, $40, $50 stock with a 2-point spread or 1-point spread, where I might feel that I can only take 500 or 1,000 shares, but even then, I'm not going to get the same upside potential. Because this is the other thing that I sometimes think about. With these lower price stocks, I'll just show you for instance. So let's say we have a stock that squeezes up here, and then I'll just draw the candles same color, just for the sake of this argument. And then we have a little doji right here. So a little bit of a pullback. And let's say we get in right here, and let's just say this is $3.10. So I get in here, and this would be a trade where I buy 10,000 shares. Now I've got a stop at $3, which let's just say is the low of that candle. And the target is a squeeze through 320 for 330. All right, so we only need to get 20 cents to get 2-to-1 profit loss ratio. So now if this thing goes up to 330, what I can do is I could easily say, you know what, this thing feels really strong. I'm gonna add another 10,000 shares here at 330. My new cost basis is 320, but now I'm holding 20,000 shares. And when it goes up to 340 or 350, all of a sudden, I'm up $5,000. And that's only on a 40, 50 cent move. That's not outrageous. It's not outrageous for me to hit $5,000 on that kind of move. But now we change this around and we say, well, wait a second, we're buying a $31 and 10 cent stock with a stop at 30. I'm not taking 10,000 shares. So now I'm taking just 1,000 shares. All right. And if it goes to 33, and seriously, if it goes to 33 and I'm up $2 a share, I'm probably not going to add. I'm like, $2 a share is huge. So, to actually get that move up to 35, that's 4, 5, 6 points. It's very rare to get that in one single candle. And if you do, a lot of times the liquidity on the stock is really difficult, and you have this huge spread where you've got 35 on the ask, but you've got 33 on the bid. And that's what kept happening today with OMH, is the ask would squeeze up. So at one point we went up to $55 on the ask, but the bid was still 52. And it's like, I need that bid to climb up. If you're going to get out and you're going to hit the bid, you need the bid to climb up. If you're going to sit on the ask, you need more volume. So one of the things that is important to look at is the relative volume, but also the total volume. Last year we had stocks, a lot of Chinese stocks like HCDI, that made 2,000, 3,000% moves, but on such light volume. It was so thinly traded. It was like on air. It was like a feather, just a feather. And the thing would pop up 15 points and then flush 20 points. And the thing went to over $2,000 a share. But it was so thinly traded. Oh my God, it'd be walking on thin ice. You didn't know when you were going to fall through. And so it was sort of impossible to feel confident trading it. The liquidity was terrible. And that's something that you really do want, is you want good liquidity, because that's what allows you to take bigger size. A trade that, you can make money, but the biggest position you can take is only 100 shares. I don't know. To me, that doesn't feel scalable. It doesn't really feel worth it. I would rather trade something that I could take 50,000 shares of if I wanted to. And in order to be able to do that, ultimately, I'm going to need to trade stock that's got probably more than 10 million shares of volume. And in fact, I find that I make the most on stocks that have more than 10 million shares of volume. So, these lighter volume stocks, and again, OMH right now is at 7.6 million shares, but, it's 4 o'clock, so it is below my threshold. And this one, being below the threshold and just the way it traded today, it wasn't safe. The risk, it just wasn't low enough, unfortunately. So you've got to be able to measure your risk versus your reward. And at the end of the day, if you don't feel you can, then the right move is to walk away. In fact, we had a stock today, HCDI, and I'll pull the chart up on this one. This one at the open, this thing was wild. So at the open right here, it halts up. How much volume was in that candle? That candle right there has 39,000 shares of volume. That's it. And it halted up. It halted up at $7.89. And then it resumes and goes up to a high of $9.50. And so when this was halted up at 789 and then showing a resumption of, I don't know, $9, I was like, I mean, 39,000 shares. How much of that would you have been able to buy? I mean, obviously it's a free market. If you want to buy 10,000, you can probably try to, but you got a lot of slippage. I don't think you'd fill the whole order. You know, all of a sudden the sellers were just gone. So that's how those spreads all of a sudden open up. You know, you have a stock where, you know, you've got your bid ask and it's, you know, $5 on the bid. And then below that is $4.50 and then $4 and then $3.50 and then $3. And next thing you know, one big seller comes in and it drops. On the flip side, you know, on the ask, you have, you know, you have your seller at $5.50 and then you've got $6.50, $7, and then all of a sudden $8, $9, $10, and just like that, the stock can squeeze up. But the problem is without liquidity, you're not going to be able to take big positions. And I just feel like if you can't take a big position, I sort of have this philosophy that if I can't take at least 10,000 shares of a stock, it's almost not even worth my time to trade it at all. I just feel like what's kind of the point? Now, again, this is me being someone who trades with fairly big size on a regular basis, but some traders will say, who cares? Just trade with 10 shares, just trade with 100. But I just feel like if the liquidity doesn't support taking big size, then it's not even worth trading it at all. And unfortunately, we sort of have this this interesting spectrum here where you've got this is what I'm gonna do. I'm gonna draw a bell curve. All right, so that's a perfect bell curve. And over here we have Bank of America. And this is liquidity from liquid to illiquid. All right. So Bank of America is very liquid, no interest, right? It doesn't move. It's so thickly traded. In fact, this is a great investment vehicle. It's a bad stock to day trade because it's not liquid. No one's going to disagree with this. So this is just a stock that doesn't move. And then you start to have some that move a little bit more, maybe Apple, maybe you have Tesla, right? And then you're going to have this sort of window of small cap stocks. You know, you've got large cap, mid cap, small cap. And so this is kind of the area where I'm going to see, I'm not going to trade here at all, but I'm going to trade a lot. So this is like my quantity of trades, trade a lot. And then once you get over a certain level of volatility and volume starts to decline, you have those HKD stocks like the Chinese stock last summer, or you have an OMH. These ones just start to get kind of on this side of the illiquidity spectrum where, you know, again, like you could trade them just like you could trade this with 50,000 shares and try to make 3 cents and make $1,500. You could trade this with 300 shares and try to make 10 points and make 3,000. But I just find that they're difficult to trade. So this is kind of the sweet spot in here. And when it comes to a spread, I would say stocks in this range are typically going to trade with a spread of less than 30 cents, less than 25 cents. So you may vary. Down here, you've got 1 cent spread. This is a 1 cent spread. Here, you might have 5 to 15 cent spreads. We could take a quick look at Tesla and just see what the spread is on that one. Let's see. Tesla. So fairly tight spread on that right now, right? Meta, fairly tight spread, 3-4 cents. Apple, fairly tight spread here, right? You know, again, these are all pretty tight spread. Now, Amazon, again, tight spread. So yeah, I mean, Pepsi, this one's going to be a little bit more thin, but still a pretty tight spread here on this one. It's a little higher price. So then you have EVOX. EVOX, this one, ELOX. This one, it looks like it's halted right now. But this one was trading with like 10, 15 cent spreads. So spreads were a little bit bigger on this one, not crazy. Let's see. We had GSIT, 4 cent spread, right? So, you know, so we kind of get into this range here of spreads in this area between 5 cents and maybe like at the high side of what I'd be willing to trade, like maybe 50 cents. This would be sort of on the high side. And then in here, you get like $1 to $2 to $5 spreads. And that just gets crazy. Again, you know, this is just my 2 cents on it. But I had the special request to do an episode on trading stocks with bigger spreads, so I hope you find it interesting. If you do, I hope you hit the thumbs up. I hope you're subscribed to the channel. And if you want to check out my link right down below in the description, you can download, there's a bunch of PDFs you can download on my gap and go strategy, my micro pullback strategy, and my technical analysis series. So check those out and stay tuned for the next episode coming soon. Thanks again, as always, for tuning in. And hey, reminder, if I didn't already mention it, trading is risky. Most beginner traders lose money, so do yourself a favor and practice in a simulator before you put real money on the line. All right, I'll see you guys back here for the next episode real soon.